We've had a lot of interesting occurrences over the last 24 hours. So we're going to talk about the German producer price index hitting the lowest level since 1949. And then we're going to move on to last night's FOMC decision and the impact that it's had on the dollar. And finally, for the trading takeout, we're going to talk about why trading what's in front of you is actually quite bad advice. So in front of us, we've got the German producer price index year on year, and quite frankly, it is terrifying. You can see really how far the country has gone in recent times, because mainly what we've seen is that the Russian natural gas situation has completely decimated German industry. And it's quite astounding, really, how fragile the economy has been based off of it. I mean, let's just take the UK, for example. So if I include United Kingdom producer prices, and we look at the year-on-year number there, it's nowhere near the same. You know, we're getting down to levels like, where are we here? About 0%, negative 0.59%, which is fine. But Germany, as a main export base, it's just quite frankly insane. Now, negative 12% is, I can't even sort of comprehend the extent to how crazy that is when you consider the context. The context matters here. So BASF, one of the big German chemical manufacturers, they've shut down production, basically. Volkswagen has shut down their production at the plant in Dresden. I believe I mentioned that just last week. And so what we're seeing now is a complete reversion of many decades of strong industrial policy. And we're heading to, quite frankly, a really scary stagnancy. And this calls into question, what does this mean for the bloc? Because Germany was one of the biggest providers to the bloc. And there's going to be a lot of political apprehension now, which provides opportunity. And we only have to look at that opportunity via looking at the euro. Again, I just want to batter home how important this long-term trend line is, and the fact that no previous highs have been made ever post a crisis. Crisis here in the great financial crisis. Crisis here with the sovereign debt crisis. Middle, again, I can't recall the specific crisis here in 2014, but I think it was coming out of the debt crisis, and there were a lot of issues. QE had ramped up, and it doesn't even matter, because basically you can see that each time there's never been a higher high made. And in the context of how bad Germany's doing currently, I think it just absolutely aids the extent to which we can say, okay, the euro is entirely bearish for the foreseeable future. There is nothing that would inspire me to buy the euro unless we somehow get a massive cut in rates, a real fast velocity of a cut in rates from the US, which we're going to go on to in a sec. But there is just no hope here for the euro, in my view, from a macro perspective, and also from a technical perspective. We can add in here the 200 weekly moving average acts as resistance right at this pin bar, literally where I've got a circle there. So it's very difficult to make a bullish case for the euro. There would be no point in me making a bullish case for the euro because I just don't see one. Perhaps there's one versus sterling, perhaps there's one versus crosses, but why make it difficult for yourself when the path of least resistance is versus the dollar and is versus down against the dollar? So the Fed held rates as expected last night, but the market got really, really spooked at one line. And it was basically Powell came out in the presser and said the base case isn't that there's going to be a soft landing. Now, the market's interpreted that as being like, oh my God, he thinks we're going to recession. I can show you that by looking at S&P 500 E-mini futures. Not on that time frame. Let's get down to 15 minutes. So you can see pretty much where he said that. So the presser kicked off at 7:30. We collapsed through this low here, rallied back up, and then he kind of said it during this period here. It's a 15-minute chart. You can see where the market completely fell off. Currently trading sub 44.45. So yeah, big bearish play there in terms of how the comments were interpreted. Now, there's always opportunity in comments like this because it was so unexpected that you can maybe say, okay, well, it was a slip of the tongue. He didn't necessarily mean that. Because the data is not necessarily showing that there's not going to be a soft landing. I mean, historically, there's never been a soft landing, especially with the yield curve inverted. But it's a perfect opportunity for those comments to be walked back. And so, if you were a betting man, which we all are, you could arguably say that there's good risk to reward in suggesting that there will be a news report that comes out that says comments were misinterpreted, much like there were with the Japanese central bank governor Ueda just the other week when he was referring to the potential for rate hikes in Japan, which the market interpreted as, very, very hawkish initially, but he walked them back soon after. And then there was a bit of a reversion. So that would be something that I would be looking out for. However, the big issue is that if he does solidify those comments, and if he does say, well, okay, I do actually think the data's changed, and it's, there's some likelihood that can happen. I'm leaning the other way though. There's some, likelihood for the data to change, and yeah, I was correct on those comments, and I stand by them. That would be the worst case scenario for risk. But for a dollar position, it'd be the best case scenario because during times of severe stress, the dollar gets massively bid. And so what we're really looking at here is a function of the euro. DXY, which is here, is a function of the euro. And so what that means is that 57.8%, I think, 57.6% of the dollar index is made up of euro moves. Okay. So when you look at the DXY, you may as well look at euro dollar. And this is the euro dollar here. So, this is the inverse of the DXY. And as I said in the previous video, it makes sense always to look at the euro versus the dollar, purely because it's the most liquid, one of the most liquid assets in the world after interest rates. So this is really what we're looking at. Again, I've got to just nail home the point every single time because it should end up being an imprint in your skulls of this chart. This chart should literally be something that you think about when you wake up in the morning. I mean, I do, but I might have certain problems. I don't know. But this is the trajectory, and you can see the bullishness that we faced yesterday in the dollar. People got bid as a risk-off proxy. People tend to think of the Swiss franc and Japanese yen as safe havens. Things have changed drastically in terms of the yen. Swiss franc has different dynamics with regards to how things have shifted. So, we're looking predominantly here at the dollar remaining a safe haven. Okay. And this is just what this meeting has provided. This meeting actually should have been a bit of a nothing burger, but those comments from Powell were the thing that really set it off. The real interest is in the November meeting, where the likelihood of going 25 basis points has been shifting quite a lot. The volatility of that market pricing has been changing quite a lot, and data could shift that again. If we start to see either rate cuts get brought forward or hardening inflation data between now and November, that number could be really volatile and really volatile for the market as well. So yes, that is the play. We're still looking at strong dollar based off of yesterday's comments. However, I would keep an eye out for anything walking back Powell's comments, because that could cause a really nice bit of risk to reward, a nice bit of skew. I just wanted to have a bit of a rant about a phrase that's told quite a lot to retail traders, which is trade what you see in front of you. And the reason why I disagree so much with this phrase is because it implies that there's some sort of certainty that you're getting out of the market. It implies that you've got control over anything, when really the only thing that you have control over is where you enter and exit and where your risk is. That is it. So trade what you see in front of you is a bit silly. Now, the other component of this is something that I ardently believe, which is direction comes from understanding how much relativity there is in the market between how events are priced and how data then affects said events, or how positioning affects said events. Basically, exogenous variables to whatever you as a trader are doing. And I think the more you're able to get to grips with this idea, this notion that you don't have any control apart from entering, exit, and how big a position size you enter with, where you pick your stop loss, for example, the more you get to grips with that, the better and more comfortable you can be with understanding, what you need to do, what you're set out to do as a trader. Because I think many people think that trading is, something which is it's a business, but it's gambling as well. At the end of the day, let's face it, there is no certainty in trading. Get comfortable with the idea of there being no certainty, and you'll probably do a lot better.